The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Squawk Box Europe. I'm telling you, the news gods have delivered today. There is so much going on with Juliana Tattlebaum and myself, Steve Sedgwick, to talk you through the next 3 hours. These are your headlines. President Trump outlines his vision for the U.S. central bank as fired Fed Governor Lisa Cook's lawsuit looks likely to go all the way to the Supreme Court.
We'll have a majority very shortly, so that'll be great. Once we have a majority, housing is going to swing and it's going to be great. People are paying too high an interest rate.
French equities and sovereign debt sells off, the country finding itself trapped in yet another parliamentary crisis of its own making, maybe, with opposition parties vowing to vote out the French Prime Minister, François Bayrou, in a looming confidence vote.
Washington slaps an additional 25% tariff on New Delhi, doubling India's total tariff base to 50% over purchases of discounted Russian oil. And it's the Super Bowl of earnings season. Nvidia gets set to close out with a bang, with option markets expecting a 6% stock move up or down.
What are you laughing at?
I wish viewers could see.
Tell them everything.
Well, before we came to Steve, he was very, very rigorously trying to post his social media clip, his second of the day, mind you, 7:01.
Hello.
There's so much to report.
Oh my God, I'm genuinely, like, if you want to play whack-a-mole on the next crisis for the market, or you want to play, get the confetti out for the next thing on the market. The French debt, not debt crisis. Well, it is kind of a deficit crisis, yeah, with political crisis. You've got Nvidia, which normally would be top of the top headlines. You've got Trump and his attack on the Fed and what that means for the market. And I've been reading voraciously about that. What else? Oh yeah, the India tariffs, just a mere 50% between two of the world's largest nations, the world's largest economy versus the nation with the largest population in the world. Wow.
And it's August. It's supposed to be quiet. It's August 27th.
Yeah, I know.
So much for that.
Yeah, it's exciting. Genuinely, I am excited. Fed Governor Lisa Cook's lawyer says that Cook will file a lawsuit challenging the president's move to remove her from her role. Mr. Trump said he was firing Cook for cause. The only way he can legally remove a board member at the central bank. But cause has never been tested in the history of cause being a reason to fire someone at the central bank. It's never been tested on a Fed governor. But there are differences of opinion, of course, over what cause means under the law. I bet there are. Meaning the legal battle over Cook's removal is expected by many analysts and economists all the way to the Supreme Court. It's going to go all the way to the top. The Fed says it will abide by any court decision on whether President Trump has the authority to fire Cook, noting that Cook plans to seek a decision that would allow her to continue to fulfill her responsibilities. The Fed's statement did not criticize the president's decision, but reiterated that the laws governing the central bank only allowed the removal of board members for the aforementioned cause. President Trump says he is considering nominating economic advisor Stephen Mirren to fill Cook's seat at the Fed. Trump has already nominated Mirren, though, to fill the vacancy left by Adriana Kugler on the board until January. But indicated he may choose instead to put him forward for Cook's seat, with a term ending, wait for it, in 2038. And that's why it's so important, because it's a long-term move if he does it. Anyway, the Wall Street Journal has reported that Trump told advisors he wants to move quickly to announce a nominee, with the former World Bank Group president, David Malpass, a man we've spoken to many times on this channel, also said to be amongst the names under consideration. Speaking at a cabinet meeting in the White House, it was a long cabinet meeting. I think they went for over 3 hours. Trump said he would secure a Fed majority and indicated that would lead to lower interest rates.
We'll have a majority very shortly, so that'll be great. Once we have a majority, housing is going to swing and it's going to be great. People are paying too high an interest rate. That's the only problem with housing. We have to get the rates down a little bit. And when we do, it's going to be a tremendous difference. The country is doing so well. It sort of blows through the fact that we have a man who's too late and not doing a very good job.
I think it's worth taking a step back to remember why President Trump cares about lower interest rates.
You're saying it's not about malfeasance from Fed governors?
Well, I think it's pretty clear what is driving his attacks on the Fed, driving a lot of the decision making around the Fed, around Lisa Cook, and that's because he cares about mortgage rates because that's what his supporters care about. He wants rates lower because it means lower mortgage rates.
I know where you're going with this.
But this could backfire. And you've been highlighting the long end of the curve all week. The Fed doesn't necessarily have control over the long end of the curve. They got control over short-term rates.
They can buy more debt, but I mean, is that the answer?
Exactly. And we're already seeing signs that it's starting to backfire.
So let me get this right. Let me talk to because I am the layman here. I'm the guy the man on the street. Fed attacked by president because president wants lower interest rates, because Fed wants his supporters to have lower cost of financing and vote for him more.
Because Trump wants lower cost of financing.
Yeah, sorry, because that's what Trump wants. But actions from the aforementioned president are now creating a sell-off in the long end, which is what mortgage prices are based on for a lot of Americans. Therefore, I'm going to use one of my ergos. I don't get many ergos now. Ergo.
This seems appropriate.
Yeah, I'm using an ergo. Ergo, president's actions are doing the absolute opposite of what president wants.
Precisely.
He's getting the opposite result by attacking the Fed. Debt is selling off on the longer end of the curve because people are worried about it and worried about inflation over a longer to medium term period. And the president is getting the opposite effect of what he wants.
Yeah, precisely.
Okay, got it.
I think it's a reminder that ultimately what's going to hold him accountable, hold the Fed accountable, is the market, and the markets do have a lot of say here. In terms of markets, let's turn to Europe because, as Steve said, there is so much news flow this morning. In addition to the Fed story and what's happening in U.S. rates, we've also got the French political story to contend with. And yesterday we saw more underperformance in the French market. Now in terms of futures, we're looking at a bounce across Europe. The Stoxx 50 indicating about 0.33% jump at the open. FTSE futures, DAX futures also higher. But in terms of the close yesterday, worth taking stock of how the French market fared, 1.7% lower. So we did close off the lows of the day. We were down more than 2% at one stage, but further underperformance, no doubt. The Xetra DAX lost about 0.5%, and the Italian market also lagged yesterday, down about 1.3%. In terms of what drove the French market lower, we saw major underperformance in the French bank. SocGen down almost 7% in yesterday's trade. Credit Ag and BNP also down quite heavily. The worst performers in the French market, if we look overall, you've got Vinci down 5.8%, and you saw the French banks pulling back. We also saw pretty steep falls for AXA in the insurance space as well, down about 4%. In terms of European bond yields, let's take a look at where things stand right now. You've got French 10-year trading around 3.4975%. That was roughly where we were yesterday. The Italian 10-year around 3.586%. That's been an interesting spread to observe in recent weeks as we have seen it narrow to historic lows. Now, a little bit more on the French story. Prime Minister François Bayrou says the government will not run away from its responsibilities. Speaking to the CFDT trade union in his first public remarks since announcing that surprise vote over his deficit reduction plans, he said lawmakers face a clear choice.
I took the risk of putting their responsibilities to members of the Assemblée Nationale, and it's a moment of clarification and truth. I can clearly see all those who, when faced with this demand for clarity, choose to purely and simply sow chaos. This runs contrary to the spirit of responsibility and joint responsibility. So in the coming 13 days, French people will press their MPs to choose and say whether they side with chaos or whether they side with their conscience and responsibilities.
Back in the day, anyway. Let's get to David Rees, head of global economics at Schroders. Now, David, I hate following the bell curve distribution in anything. I like to actually think of the outliers. But when it comes to economic orthodoxy, it seems that it is very clear that if you undermine the central bank responsible for the most important reserve currency on the planet, that is going to lead to a bit of a wobble in the underlying debt of the country of that central bank. Am I being really dumb here? Are the detractors of the US president and his policy at the moment to undermine the independence of the Federal Reserve? Are we all missing something? Are we being incredibly stupid? And the man who is famed for the art of the deal, is he getting something very right?
I don't think so. I mean, we think the US economy is in pretty good shape. And so the idea that you need to cut interest rates at the moment when growth is strong and inflation is a bit elevated, it goes against the kind of mandate of the Fed, frankly, unless the economy has really hit a soft patch. We don't think it has. So cutting rates now, forcing rates down now becomes self-defeating because you get worried about inflation in the future. So that's putting upward pressure on long-term interest rates at a time as well when the US needs foreign funding, right? And so if you're deterring your kind of funders, if they're a little bit less willing to buy your debt, and we've kind of seen that over the course of this year since Trump came in, then the natural course of action is that yields are going to rise at the longer end. And that's what we've seen. It's quite contained at the moment, right? The 30 is not really cracking 5% in a meaningful way, but long-term yields are rising, and we think that's going to continue.
Can you go into a little bit more detail on what you think is driving the long end of the curve here? We were just discussing, obviously, how the Fed doesn't control that. Obviously, it's a factor where rates are set, but it's not what ultimately drives rates at the long end.
Yeah, it's our old friend term premium, right? So the nice box that explains everything that we don't know. But I think really we're talking about concerns about inflation, probably broader concerns about the government overstepping, and that, again, that kind of toxic combination against the need for foreign funding. And so if you've got less buyers at that price, and of course yields are going to be rising. And I think that combination really.
Do you think that Fed Chair Powell is seeing something that you're not, that's making him more friendly to the idea of cutting rates? Because clearly he did sound more dovish, open the door quite widely for a September cut. But, you just said the U.S. economy doesn't need cuts right now.
Well, let's be fair. So we went through a period of enormous uncertainty about trade policy, fiscal policy, you name it. We didn't really know where things were going to land. And in that environment, it seems like we did hit a little bit of a soft patch for growth, a little bit of a soft patch for hiring. But our view is that you've now gone beyond that period of maximum uncertainty. So if that really was driving a bit of weakness, that should start to ease away. And basically the fundamentals of the US economy are reasonably good. The sovereign side is in a mess, but the private sector balance sheet, the consumer balance sheet is in pretty good shape. And so long as they don't pull up the drawbridge and start saving, we think that's good fundamentals for growth.
You talked about the largesse of foreigners. My word largesse, because I love it, because I love speaking German. The largesse of foreigners, the kindness of foreigners. We hear about it a lot in Great Britain, about buying British gilts as well. We're relying on the kindness of others to buy our debt. If you, for want of a better word, I'm trying to upset two of the largest surplus economies in the world, let's just call them China and India for sake of argument, or two of the largest buyers, or let's make it three, China, India and Japan, the largest buyers on the planet of US debt as well. And you slap 200% here, you threaten on this one, and 50% of debt on the other. Are those foreigners likely to buy more or less of your debt?
No.
I know I'm asking a dumb question, but I'm getting to the point that it's tariffs as well as the Fed policy.
Yeah, of course. You put it all into the mix. So at the margin, clearly the appetite is probably going to be less. Also, for those economies, think about Japan in particular, domestic yields now are significantly higher than they used to be.
So there's less. Is that happening?
There's less need to go abroad to earn some yield now, right? For those Japanese.
Is that happening? I've heard a lot about it in 2024. Not seeing the evidence yet.
Yeah, I don't think we've seen it in scale. We don't see that big repatriation. But in terms of moving markets, it's about the marginal next move, right? And so if the next bid is a bit weaker, then it means yields are going to go up and the dollar's going to go down. And that's what we think is basically going to be playing out over time.
There's a lot of talk about this new era of so-called fiscal dominance, whereby central bank policy becomes more dictated by governments' need to keep borrowing costs low to service these huge debt loads than anything else. Why isn't the market more concerned about this new era of fiscal dominance?
Well, I guess it's not that new, is it? Because you had it post-GFC. So it's not completely new. Almost the market is conditioned on that to some degree. The difference now is that you don't have a big deflationary bust in the global economy. You've actually got inflation as the problem, and now you try to suppress interest rates, which is the wrong mix, right? Because you end up with inflation. Then the aim was to escape deflation and get inflation up to a sustainable level. Now you risk firing it up, overheating, getting higher inflation ingrained. that's bad news for the long end of the bond market.
Yeah, I hear your question, and it's something I've pondered a lot, actually, and spoken about a bit on this show. I'm just wondering if the old mix, and you're an economist, not a strategist, but the old mix of where 60-40, I put my 40% into bonds because they're safe. They don't feel very safe at the moment. They do not feel safe in the short, medium or longer term as well. Yeah. Have we got to change our long-term assertions about the safety of the bond markets?
Yeah, look, we'll see a test case where we actually hit the next recession, and you'd be talking about the US as things stand of, a deficit blown out from 6 to 10, or for example, we'll see if they're really that safe in that environment. But I think it's right. I think they're there to earn yield. They pay you a decent return now, but in terms of the safe haven, not so sure, and that's why things like gold have been doing so well.
We've got to leave it there. Love this conversation. Thank you, David.
Thank
really
you.
Nice to see you today, sir. Thank you for walking us through it as well. David Rees, who is Head of Global Economics at Schroders. And we're going to hear exclusively from the New York Fed President John Williams later today. That conversation, 1:30 London time. And for more on what President Trump's Fed pressure could mean for Wall Street, check out CNBC.com and find out what happened to markets when President Nixon pushed the Fed to loosen policy in the 1970s.
Coming up on the show, investors are closely watching NVIDIA earnings with the AI darling set to report after the closing bell. We'll break down what to expect. Plus, the U.S. doubles tariffs on India over purchases of Russian oil as relations between the countries sour. We'll look at the possible implications, and we'll discuss tariffs and the outlook for the global economy with Nobel laureate Joseph Stiglitz. Don't miss that conversation later this morning. Welcome back to the program. NVIDIA is set to report its second quarter earnings today, but will it be another blockbuster quarter for the Wall Street darling? Analysts are expecting the chipmaker to post $46 billion in revenue for the July quarter. According to FactSet, that would mark growth of 53% year over year, a slight drop actually compared to the previous quarter, and well below the mammoth surge in 2024. Arjun joins us now with more on the numbers. Arjun, looking at the options market, looks like this could swing pretty wildly in either direction, suggesting we really don't know which way it could go. What exactly are analysts and investors going to be watching today?
Yeah, it's always a big mover potentially, NVIDIA. Look, three things. I think the first is NVIDIA is going to come up against the law of big numbers. It can't obviously sustain this sort of 200% revenue growth we've seen, but the market looking for around 53% growth, and the market's hoping that NVIDIA not only will meet that, but kind of has to beat it, I think, given the high expectation here. So that's the first thing. The second major theme here is going to be China. What's happened so far is NVIDIA first wasn't allowed to sell those sort of slightly slower H20 chips to China. It then was allowed to, on the condition it gives a 15% revenue cut to the US government. So the market now is looking for what the revised outlook's going to be. NVIDIA previously said it lost around $8 billion worth of sales by not being allowed to sell to China. What does that revised outlook is now, including that 15% cut to the government and including potentially impact from reports we've heard the Chinese government is trying to discourage local firms from buying NVIDIA chips. Is NVIDIA seeing any impact from that on demand? And then also related to China, NVIDIA CEO Jensen Huang recently said he's talking to the US government about looking to sell a slightly more advanced chip to China. How are those discussions going? And just finally, we've heard from the hyperscalers over the past couple of months that they're continuing to spend billions of dollars on AI infrastructure. I think collectively they're looking to spend north of $300 billion this year. How much of that is going to NVIDIA and how much demand is NVIDIA seeing there? So really these earnings will give us a look into the sort of demand both from China but globally as well for this AI infrastructure.
Great. Thank you. Brilliant summary. As it was on our social media thing this morning. It's gone viral, by the way. Combined TikTok and Instagram, we've got about 250 views.
Oh, my God.
I know.
Big time.
I know.
Well, look, people are just waking up. People are just waking up.
It's always someone awake.
Is it?
Beer o'clock somewhere in the world always. Influencer, yeah. But in all seriousness, The thing that we talked about a lot last year, we barely mentioned now, and that is the moat. The moat to keep intact the fact that everyone growing, all those hyperscalers and all those Chinese and everyone else need to buy NVIDIA chips. How is that looking? Because obviously this is the week where we've heard about extra funding, extra shareholder in Intel from the government, and there'll be other players, and we talk about the Chinese and how they're going to develop their own chips. How does the moat look?
The moat still looks intact.
Yep.
It still looks strong. I think there is still a huge desire for people to get their hands on NVIDIA chips, both sort of outside of China, but also within China. And so there's still that demand. And of course, we've spoken about this many times. It's not just sort of the NVIDIA system they're buying. It's the connecting cables. It's the software, which is incredibly important for this story as well. And the lock-in to that NVIDIA ecosystem. So that still remains. But the story regarding challengers, regarding those companies that want to try to take a slice of this pie, that's not gone away. One of the interesting stories this morning actually out of China, Cambricon Technologies, which is one of the sort of local domestic players, swung to profit in the first half of the year, has about 100% stock rally as well. And a lot of that boost it's seen, particularly on its profit, on its revenue, has come from that domestic demand. So that story is interesting because you are seeing demand for some of these domestic chips in China as the companies there realize that they're not going to perhaps only be able to rely on NVIDIA for the coming years. And so there is that story playing out in China, domestic challenges. But globally right now, I think NVIDIA's moat still very much is intact.
In the world of analysts and sycophancy towards the hot new thing as well, I'm back on looking at the distribution of analysts' estimates for this stock going forward. I have currently, 65 analysts' recommendations in front of me. I've actually got one sell. I'm shocked. I've got 6 holders, 37 buyers, and 21 strong buyers as well. Everybody still loves this stock, despite the fact that it trades on 30 odd times forward as well. How do you feel about that?
Yeah, it's still a lot of that conviction, I think, is still coming from this idea around the moat, and I think what we've heard from the hyperscalers. Look, there's still this view in the market that this AI infrastructure build out is still in the early innings. It's still just getting going, and if the hyperscalers are continuing to spend this kind of money, they're going to be spending it on NVIDIA because that is still the gold standard for the type of semiconductors they need to carry on building out their AI software, their AI services. So that, I think, is where that conviction comes from. There's always a risk here that actually, and we've seen this with any kind of technology like this, that disruptions can come thick and fast. We saw that with DeepSeek, and there continues to be rapid development of competitors and of newer forms of this technology, which could kind of blow this market up at any point. And that, I think, is kind of the big risk here.
I was going to ask what the main bear case is at this point, whether it is simply a question of valuation or the risk that the moat erodes sooner than the market is expecting. It's fascinating. There's only one seller out there among the analysts that Steve just...
I'm amazed there's one, to be honest.
I mean, when you look at a stock that is such a consensual long, it's so popular among retail investors, and there had been so much talk about it being overvalued last year, but it feels like the conversation has become so much more wholly positive around this stock. But what is the main bear case?
Yeah, I think what I've spent a lot of time over the last year or so looking at some of these challenges, some of these startups doing interesting things in chips. And one of the things they're talking a lot about is GPUs, the type that NVIDIA design, are very power hungry. And perhaps they might not be the best architecture going forward when we think about large-scale AI. And so there's some of these newer players coming up trying to design architecture that's perhaps more efficient.
So less energy-intensive architecture.
Exactly, for so-called inferencing, the actual carrying out of these AI sort of applications. And so there is a view that actually going forward, that part of the equation, perhaps inferencing, is where NVIDIA sees more of the challenge versus all of this large-scale training. And so that's one of, I think, the bear cases, that in this world of large-scale inferencing, NVIDIA doesn't have as strong a hold. And of course, the other point here is just around near-term demand. I think more than anything is, will all this sort of money being pumped in by the hyperscalers yield some sort of investment? If they're seeing next year actually the demand for our services is not that strong, do they begin to pull back on that spending? Because I think a lot of the valuation, a lot of what's happening with NVIDIA is the idea that it remains, demand remains strong, and it is the only game in town.
I think that timing issue is important, because these recommendations, when you look at price targets that analysts are setting, are typically on a 12-month view. So it doesn't necessarily reflect the assumption that they believe in the NVIDIA story over the long term, but they have to put a timestamp on
and I'm not
their recommendations.
Unbelievably cynical, but it's hard to get your clients to buy stuff that you are selling, or your sales team are selling, if your analyst doesn't like the underlying stock. But then that's me being cynical about the sell side. I'm a bad person. I'm a bad person. Stop it. Archie, that was brilliant summary. Thank you very much indeed. Apple has announced it will hold a launch event on September 9th. The tech giant is expected to unveil a new iPhone 17 lineup with updated processors and an improved, slimmer design. AI will also be in focus. Just last week, rival Google released its newest Pixel 10 phone, touting new user-friendly AI features. Apple has reportedly, held internal talks about buying the French AI startup Mistral, as well as Perplexity. The story was initially reported by The Information. Meanwhile, Perplexity told Reuters it was, quote, unaware of any merger conversations including the company, aside from its own deal.